Hello, welcome back. So in today's video, I'll be talking about the stocks that I'll probably never buy. So in today's video, I'll be covering a few things. We'll be covering why I've avoided these stocks, the markets right now, as well as some questions that you guys have left me in the comment section below. So let's go into the first segment first, which is the stocks that I'm avoiding and the stocks that I'll probably never buy. So the first stock is Tesla. So Tesla today is now around 8%, and the stock depends on a lot of different things. So whether or not the stock goes up, it's not because of the fundamentals of the business, but because of stories, narratives, and everyone talking about how Trump will help Elon Musk expand the robotaxi network. So Trump has called out Elon Musk after the alleged field online. So Elon Musk, he completely disagrees with the view that Trump is putting out, and this is Trump's response to it.
Well, look, I've always liked Elon, and it's always very surprised. You saw the words he had for me, and he hasn't said anything about me that's bad. I'd rather have him criticize me than the bill, because the bill is incredible. It's the biggest cut in the history of our country. We've never cut. It's about 1.6 trillion in cuts. It's the biggest tax cut. You would say, people's taxes will go way down. But it's the biggest tax cut in history. We are doing things in that bill that are unbelievable. And when you look at what we're doing for small businesses, for people, for middle-income people, all of the things that we're doing, nobody's ever seen anything like it. And Elon's upset because we took the EV mandate, and which was a lot of money for electric vehicles, and they're having a hard time, the electric vehicles, and they want us to pay billions of dollars in subsidy. And Elon knew this from the beginning. He knew it for a long time ago. That's been in there. I would say, JD, that hasn't changed. That's been right from the beginning, Mr. Secretary. That hasn't changed at all, right from the beginning. But I know that disturbed him. He wanted, and rightfully, he recommended somebody from that he, I guess, knew very well. I'm sure he respected him, but to run NASA, and I didn't think it was appropriate. And he happened to be a Democrat, like totally Democrat. And I say, look, we won. We get certain privileges, and one of the privileges, we don't have to appoint a Democrat. NASA is very important. We have great people. General Kane is going to be picking somebody with our. We'll be checking him out, seeing. But he wanted that person, a certain person, and we said no. And I can understand why he's upset. Remember, he was here for a long time. You saw a man who was very happy when he stood behind the Oval desk, and even with the black eye, I said, "Do you want a little makeup? We'll get you a little makeup." But he said, "No, I don't think so," which is interesting and very nice. He wants to be who he is, so you could make that statement too, I guess. Look, Elon and I had a great relationship. I don't know if we're well anymore. I was surprised because you were here. Everybody in this room practically was here as we had a wonderful send-off. He said wonderful things about me. You couldn't have nicer. Said the best thing. He's worn the hat. Trump was right about everything. And I am right about the great, big, beautiful bill. We call it a great, big, beautiful bill because that's what it is. And again, biggest tax cuts in history, biggest economic development moves anywhere. We've never done anything like it.
So Trump and Elon are clearly not getting on well, and this is from a Tesla bull as well. This is a comment that I saw in my comment section. So he says, now if you're going to say Tesla is only a car company, then what about all those FSD subscription people pay for? I have, it's phenomenal, and I've done that in multiple different countries. So he also said that every Tesla ever sold has a robotaxi capability, meaning they don't need to produce them. They already have 7 million of them. Anybody at work can have their car make them money as a robotaxi if they own a Tesla. People might hate Elon, but you know what they like? They like money. This does not even bring up how Tesla has already been well trained to fully scale. They don't need LiDAR. Have fun mapping out the maps. Just because a company has competition doesn't mean they're in trouble. People delivered packages before Amazon. There was social media before Facebook and smartphones before Apple. It's about who has the best product, and Tesla is the best product. Don't believe me, I dare you to rent one that. So there are a few things that he addressed here. So number one, he's saying that there's 7 million robotaxis that people own that can be used as a robotaxi fleet. But as a human being myself, I don't feel comfortable having people step into my car and using it as a taxi itself. And secondly, 7 million robotaxis, yes. Out of that 7 million people, it will take a while for adoption to come into play. So that is one headwind for Tesla as well. Don't expect the 7 million people to suddenly sign up and have their cars serve as robo-taxis. And then the other argument that he made was with regards to LiDAR. So for Waymo, they use LiDAR, whereas for Tesla cars, they use their FSD camera capabilities. So the difference between those two technologies is that LiDAR is a lot safer. But the problem with LiDAR is you have to map out all the different cities into your system itself. And for Waymo, they have to do that for every single city that they go into. Whereas for Tesla, they don't have to because it's just a camera eye that just drives around the entire city. So his argument here is that Waymo cannot scale because Waymo have to map out the cities of almost every single country in the world for them to step into the industry, whereas Tesla doesn't need to. But for Waymo, the counter argument is this. Waymo only has to go into the biggest cities and gain the biggest market share there. They don't have to map it out into their third world countries that don't require all these services. Because the Uber services there are already at a very cheap price as compared to all your different robotaxi networks. The robotaxi won't be able to provide a lower cost advantage compared to the Ubers there. So I don't think there's a need for you to map out every single corner in the entire world. As for Waymo versus Tesla, Waymo is a very small portion of Google's entire story. It only makes up around 50 billion of the entire $2 trillion market cap. Whereas for Tesla, the entire story right now, the entire $1 trillion market cap is solely dependent on this robotaxi working. So you see the risk to reward there, it clearly isn't in favor of Tesla. And for Tesla to win, they have to basically have everything go in their favor. So they need regulations coming into play. They need people to adopt this robotaxi story. They need to be able to fend off all the competition in the space from Waymo, from Zoop, and all your different other robotaxi companies as well. So for Tesla to click, you need a lot of different things to play in the right direction. And that's why I think it's a very risky bet right now. So from a valuation standpoint, Tesla is extremely overvalued right now. So the stock is trading at 171 times earnings, 105 times forward earnings, and it's sitting at a 9 peg right now. So it's incredibly overvalued. And earlier he also mentioned that Tesla has other revenue streams. But if you have to look at this revenue chart over here, which is their earnings from 2025, majority of it comes from automotive sales, whereas the services and the energy portions only make up very small chunks of the entire revenue. So yes, Tesla makes money from the FSD, Tesla makes money from the energy storage system, but this car foundationally is still a car company. They make most of their money from selling cars, and the car deliveries are slowing. So my summary for Tesla is this. There's key man risk, core business is churning away, there's competition, and then there's political risk on top of that as well. So a few months ago, everyone was saying how Trump will help Elon Musk basically push the robotaxis into the market, but I don't think that is playing out right now. Tesla was an anomaly. It probably will still be, but this is too risky for me. I don't see myself ever buying into this story, let alone buying into the stock. Next stock that I would avoid is Palantir. So Palantir year to date is up 71%. Currently now it's trading at a 500 times earnings. So for Palantir, it's a very short one. The valuation just doesn't make sense anymore. So I plugged in Palantir into a DCF calculator and I stretched it out over 10 years. And I put a growth rate of around 40%. So a majority of their free cash flow now is still made up by stock-based comp, but let's just ignore that fact. So assuming a 40% free cash flow growth for the next 10 years, and assuming a 10% discount rate, this stock is trading at a fair value of $109 a share. Currently now the stock is trading at upwards of $120 a share, so it is still overvalued even with this crazy metric over here. So for Palantir, I just don't see the story anymore because the valuation is so overstretched to the point where value investing in this one clearly doesn't make sense anymore. So for Palantir, it's an avoid. I don't think it will ever come back down in terms of its valuation unless something fundamentally goes wrong with the business. So next set of stocks that I'll avoid as well is your airlines industry. So airlines industry stocks like Delta Airlines haven't performed very well over the past 5 years, even with this cheap multiple. So most of them have less than 10 times of earnings, and yet the stock has criminally underperformed the S&P 500. So for airlines, as you can see on the left as well as on the right, the airlines industry has grown massively over the past years and will continue to do so. So it's around a 9% CAGR all the way until 2029, which is quite remarkable growth. But if you're to compare that with the stock price itself, the stock price and the ETF itself hasn't grown much because there's too much competition in the space. So for airline stocks, they face too much competition in the space, and the only way for all the companies to gain share is to lower costs together. And when they lower costs, this eats into their margins and their profitability as well. There is very little premium paid for the quality of the experience on an airplane itself. And most people that search for airplanes, they only want the cheapest ones. As long as the safety threshold is there, they won't pay an extra dollar for the extra experience that they have on a certain airline. So for airline stocks, they are generally avoids. I'll likely continue to avoid them in the future. Next set of stocks that I will avoid as well is your pharmaceutical stock. So this is Novo Nordisk. Novo Nordisk is down around 17% year to date, currently trading at a 20 times earnings. So pharmaceutical stocks, they normally face a lot of regulation because it concerns people's health. It's a difficult business to understand as well. You need to understand all the different drugs and all the different pipelines that they have. It's complex with all the different drugs that they have. So for example, for Novo Nordisk, they have their CagriSema, they have their Ozempic, they have their Wegovy as well. Then they have all the different pipelines of drugs coming up as well, which is just confusing overall. And overall, there is no edge in the field unless you're a doctor working in the space. So a lot of the biotech companies, they have this strategy as well, which is your buyout strategy. What they do is they'll create a drug, get a patent for it, and then they'll sell out their company. Normally, when you have a company like this, normally when you try and invest in a company like this, it is highly unpredictable and it's almost gambling at that point already. So for biotech stocks, as well as your pharmaceutical stocks, I think that typically avoids, and I won't be buying them anytime soon. Same for Novo Nordisk, although it dropped down to a very cheap valuation. So next portion that I'll be talking about is the market valuations right now. So the market's valuations are quite high right now. The S&P 500 is trading at a 28 times earnings. And the only 3 other times when the valuation was this high was in 2022, 2000, as well as 2008. 2000 and 2008 were your major crashes, whereas 2022 was your bear market year. So overall, the market valuations are extremely high right now. I don't think buying into the S&P 500 is a very reasonable bet. But despite this overvalued market, I think there's still some opportunities in the market, and there's one that I would like to highlight right now. And this stock is LVMH. So LVMH year to date is down around 20%. Currently now, the stock is down around 1% today, trading at around 18 times earnings. So for LVMH, this will likely be a bad year as well. So there's this other company called Brown-Forman. They sell your Jack Daniel's whiskey, and today they released their earnings, and their earnings were a lot lower than expected. And today, the stock has dropped around 16%. And that's why you're seeing LVMH drop as well. LVMH spirits portion make up around 8% of the total revenue, so it's not a very big hit for the business itself, but it is not a good one to look at. So for LVMH, it's currently trading at one of its lowest historical valuations in the past 10 years. And if you have to compare this stock to its competitors, like Hermes, Richemont, currently now Richemont is trading at a 25 times earnings, Hermes is trading at a 53 times earnings. So LVMH and an 18 times earnings seems about reasonable. I'd like for this stock to drop to around $100 a share or even $90 a share. I can get it at around 17 times earnings. That'll be when I'll be expecting this stock to achieve alpha over the market with some multiple expansion as well as some growth coming ahead as well. This year will likely be a down year for LVMH, so let's see what happens next year. Last portion, I'll be talking about some questions that you guys have left me in the comments. So the first one, it says don't sleep on Grab. So Grab is a company that is quite dominant in Singapore, my country over here. So for Grab, the problem with the business is this. The ride-hailing industry is extremely saturated in all your different Southeast Asia countries. So for example, in Singapore, you have other alternatives like Tada, Gojek, all your different other ride-hailing companies in Singapore as well, fighting for market share. So Grab's biggest bet is in Southeast Asia, and I don't think they'll be able to expand into other countries, other wealthier countries in your Europe and US and so on, because you have dominant players in those spaces like Uber, which owns a large portion of Grab. But when I'm using their service itself, the only thing that I'm comparing is the price itself to all the different other apps. So this isn't much of a competitive advantage for Grab, and that's why I don't think I'll be investing into this one. I'm not too sure what the thesis could be for Grab, but let's see how this one plays out for Grab as well. Next one is on Evolution Gaming. So what do you think about a stock like Evolution Gaming? Any ethical or moral concerns? So when it comes to investing, I don't think there should be any moral concerns. So for example, a tobacco company like Philip Morris has performed very, very well over the past few years. Same for a company like Ultra. And for Evolution Gaming, I don't think it is the moral or ethical concern that is holding me back from owning the stock. I think the problem with the business itself is it has too much of their revenues coming from unregulated side, and the entire growth story for the business is simply just hinging on the fact that they remain unregulated. So for example, for Evolution Gaming, a majority of their growth is coming from Asia, and Asia has the largest chunk of your unregulated side. So they're already getting regulated in other countries like your EU, in UK and so on. But currently now, I think the stock is extremely undervalued. It is currently now trading at a 10 times earnings, giving around a 5% dividend yield. If they can just hold this dividend stable and achieve a 5% revenue growth for the next few years, that is already a 10% growth without any form of multiple expansion. So for Evolution Gaming, I think it's a stock that's extremely undervalued. For deep value investors betting for turnarounds, I think this is one that you could look into. But for me, I don't think it is a business that I understand enough. And for me, the unregulated side concern is a real one, and that's why I'll be avoiding this one. I hope you guys have found this one useful and invest safe.